This is going to blow your mind. A Florida home for less than the price of a used car today. It's not a shack either. I found the old ad. For under $8,000, you could buy a full-blown house by the beach yet. This is a real ad from 1955, and what's wild is that homes like this, 3 bedrooms, a decent lot, screened porch, carport, close to the beach, we're going for $7,900. There's even more here. It's not just that it's Florida. This is from the Miami area, one of the higher price markets in not just Florida, but all of America today. There's actually something even more amazing about this ad that I want to show you and what this all means to your personal financial strategy, big picture. I'll also tell you when the average home will cost $4 million in the United States. Hi, I'm Keith Weinhold, Get Rich Education founder, Forbes Real Estate Council member, best-selling author, and longtime real estate investor. Look at this. The monthly payment is under $48 for the 2-bedroom and under $50 for the 3-bedroom. And this actually covers more than just the mortgage. That tiny payment amount for less than the cost of a dinner was the cost of the mortgage principal and interest, the property tax, and the insurance. I mean, can you imagine a Florida couple's home buying conversation 70 years ago? Like, honey, you're crazy if you think we're going to pay an extra $2 per month for a 3rd bedroom. Wow. Note how low closing costs were too. Now back then, loan durations were often shorter than 30 years. So these under $50 monthly payments, they could have even been for a 15 or 20-year loan. It doesn't say that in the ad. Down payment amounts were often larger than 20% back in the 1950s too. Now to be sure, wages were lower then, but look, only one parent had to work. They still managed to buy homes, raise a family, and even pay for a milkman who actually delivered the milk. We'll compare this more to today's home prices shortly, but understand this first. Inflation is not a rise in prices, actually. It's an expansion of the money supply. That's where the root term inflation comes from. And that expansion of the money supply results in the devaluing of the paper or fiat currency. So therefore, you need more dollars to buy the same goods. You need more dollars to buy the same home. This is why the gap between the ones who own assets and the ones who don't will continue to widen. Interestingly, people blame everyone for the loss of their purchasing power except for the ones who are actually causing it. It's not greedy corporations, boomers, speculators, billionaires, investors, or whoever they tell you to hate. It is the government, central banks, and the paper money system that they created. And this misunderstanding is actually what keeps the system going for now. Understand the importance of owning hard assets because all fiat currency will eventually be zero, as history has shown. So position yourself accordingly. I mean, Voltaire said that paper money eventually returns to its intrinsic value, zero. We already know that inflation kills savers, so you want to do the opposite of save, which is not spend. Spending your dollars is merely a hedge against inflation because when you spend for a car or a vacation or an electric bill, you get rid of those dollars before they get debased by the government. The opposite of saving then is to be a savvy borrower, since responsible borrowing is actually how you profit from inflation. 30 years ago, the US median home price was a charmingly modest $130,000. So you don't pay all cash because you would have only hedged against inflation on that home, meaning break even. Follow along here because this will create a lesson for your future. If you had instead borrowed for this, call it a $130K rental property with your 80% loan and even zero principal pay down, your mortgage balance would be a featherweight $104,000 today after 30 years. I mean, that's less than some people's Amex card limit now, and it's just 25% of today's median home price of $416,900. See, an 80% loan went to a 25% loan. How? Inflation. And this is a really stark example of inflation profiting, how your debt gets relentlessly debased by the Fed, and in an income property, your tenant would make all the monthly payments too. Your 104K is easy to pay back for today's median home because inflation made your salary go higher, made prices go higher, and made rents go higher. That's the lesson. Inflation makes debt feel low and cheap and easy to pay back over time. Even as recently as 2011, we can feel kind of flabbergasted about how the median home price was just $211,100. And how is the median home price double that already? As we look at this chart, see how much debt the government has created since then. And then this shows how they need to keep printing more dollars in order to pay it back. And the result? It debases all the dollars that savers hold onto. I want to tell you about the future next and when the average home price, just the average one, will go to $4 million. You heard that right. First, go ahead and put a like on the video if you like how I'm breaking it down. Really appreciate the thumbs up. And if you're serious about building real wealth through real estate and you want the strategies the pros aren't sharing on YouTube, you've got to get my free newsletter. I'll show you how to grow your portfolio, boost your cash flow, and protect your wealth in any market. Just text GRE to 66866 and you're in. It's quick, it's free, the letter's packed with value, no AI bot. I write it myself and it takes less than 3 minutes to read. And we don't send you intrusive texts either. It's an email letter. While it's on your mind, text GRE to 66866. With today's median home price at $416,900, future generations are going to marvel at today's low, quote, $417K median home price the same way that we do at this 1960s McDonald's menu where a burger was really only 15 cents. And of course, this is also when restaurants serve real meat and French fries cooked in tallow rather than seed oil and shakes with real cream, all evidence of simultaneous skimpflation here, skimping on ingredients over time, or the same way that people are going to be flabbergasted or they'll marvel at today's low home prices at the same way people are flabbergasted at this 1955 Miami area real estate ad where a full home near the beach was under $8K. Well, look, as we see that homes cost about $40K in 1975, they have 10x'd in price since then, and that's why in another 50 years or so, 2075, 2080, the average home could surely cost $4 million. I mean, with the way that our government cost in interest on the national debt alone has ballooned to over $1 trillion every year now. I mean, you can make the case that a home could cost $8 million or $10 million in the year 2075. The bottom line here is that zooming out over time reveals a clear, uncomfortable truth. Savers get roasted, spenders hedge, and borrowers get rich when your tenant makes the mortgage loan payment for you. The real estate market is not broken, the dollar is. There's more here, also more on why the average home should cost $4 million in the future right here.